Tech stocks are dropping fast. Nvidia, AMD, the cloud companies, software, all of tech seems to be dropping. So the big question that's coming up now is this an opportunity that we should be buying? Or is this a trap that we should be avoiding? Today I'm breaking down exactly what is causing this move, why pullbacks like this are actually healthy, what are the risks that no one is talking about, and what is the approach that you should take in as an investor so that you don't guess or panic. And be sure to stick around to the end where I'm going to share exactly what I'm doing in my personal portfolio and the strategy that I use every single time we see pullbacks like this. Let's get right to it. So let's start off with what is causing this pullback, because let's be honest, this is not random. There are multiple forces here at play, and when you have all of them stacking on top of each other at once, this is a recipe for a pullback. The biggest reason that tech stocks are pulling back is because of interest rates. The market was pricing in aggressive Fed interest rate cuts to help battle inflation, and basically what happened is the Fed came out and said, just kidding, we're not doing that quite yet. And as soon as that happened, all of tech stocks started to pull back. If interest rates stay high, companies are less likely to borrow money, which means that they are less likely to invest in future growth. The general rule of thumb is the higher the interest rates, the worse the market does. The lower the interest rates, the better stocks do. And specifically tech as a growth driver is heavily driven by interest rates. Tech stocks thrive in low interest rate environments because it makes their future earnings growth look even better. So when the Fed came out and said, by the way, we're delaying super aggressive cuts, it immediately made future growth look worse, valuations of stocks needed to shrink, and that's what caused everything to sell. Second, AI expectations are sky high. Wall Street has priced a lot of the stocks for perfection. And don't get me wrong, the AI boom is still growing and still real, but hype plays a really big role. When hype gets too much, even if earnings beat, this can cause fantastic companies to slide because hype was just not met at that point. This is one of the most important things for people to learn when it comes to investing is that sentiment matters. It's not just about earnings. If people want a reason to sell and the media keeps pushing a reason as to be negative for everything, people will get negative and they will sell the stock regardless of earnings. Third, we're in the middle of a massive profit-taking phase. People are heading into year end with really large gains coming off AI and tech, and honestly, it's been a very good year leading up to this point. Big hedge funds that own these stocks, they want to clear profits before the end of the year and reallocate as they go into the next year. When big hedge funds sell, it's lots of shares moving, and it causes very aggressive moves in the market that can take an entire sector down with it. And that's exactly what you're seeing now. Fourth, what you're seeing is the classic stocks rotation. People are taking their gains in tech and moving it to more safe things like value plays, banks, industrials, so that they feel like their money is more protected. This happens every single time tech has had a really big run. What you're seeing is people just repositioning, and it doesn't mean that tech is necessarily broken. This happens really often as people close out their portfolios and think about the next year. And finally, a lot of these stocks had really stretched valuations. You can only keep growing vertical for so long before it's time that even the best stocks in the world need to take a break. So when you combine higher interest rates, unrealistic expectations for AI, hedge funds beginning to take profits, sector rotations, and stretch valuations on stocks, this is a combination that leads to a very explainable pullback. But here's what people are not talking about. Not all of this is bad news. What we are seeing here is a healthy market pullback. And that's what brings me to my next section. This pullback feels scary, and honestly, every pullback feels scary. But what's healthy about this one is that it was really long overdue. First, the AI story has not changed. We just heard earnings from the biggest companies in the world, all saying the same thing, that they plan to increase their spend on AI, buying more GPUs, building out more data infrastructure to support their AI plans. This was the reason that their stocks went up in the first place. So even if the stocks are cooling off, their AI investment is warming up. Second, this isn't 2001. These stocks are not trading on hype. They have real earnings. Chip demand is huge. Software margins remain high, and we're seeing companies across the board trying to find ways to integrate AI into their future technology plans. In other words, the fundamentals of the companies that we bought within tech are still holding up, even though the stock prices are not. Third, a correction resets value. And that's a good thing. Was there a stock that you've been sitting on the sidelines just watching run as it gets more and more growth? Now is your chance to jump in. And this is a good thing because sometimes stocks run for too much, and even really good news cannot push a stock over the hump because it's moved up too much. It's important to remember opportunity does not come when everything is green. Opportunity comes right after everything is red. Fourth, the overall market needed a sentiment reset. The fear and greed index was sitting sharply in the extreme greed area for weeks. This sets up a situation where people just assume that stocks are going to go up regardless of underlying fundamentals. When stocks are expected to only go up, it sets up a really dangerous situation. And this pullback has really removed that sentiment and made the euphoria of the market go away. And honestly, for myself, I'm a lot less worried now after this tech pullback has recently happened. And finally, now some of the strongest companies in the world are 10, 15, and even 20% cheaper than they were on better earnings than they've ever had before. That is the combination of a better business on a cheaper price equals opportunity. But let's be honest, it's not all sunshine out there. There are real risks that could still happen. So in this next section, I'm going to dive into what those risks could be that could easily turn what seems like an opportunity into a trap. So let's start with the first big risk here, and that's that even after the 10 to 15% pullback we've seen broadly across tech, a lot of stocks are still expensive. So we're a little bit less expensive than we were, but if earnings slip up at all or get soft, there could easily be more room for things to fall down. Second, AI is real. The demand for AI is real, but the cash flow coming from AI can sometimes take more time. And if investors get impatient waiting for cash flow to catch up to sky-high expectations, this can lead to choppiness and moments in the market where it looks like stocks are going to continue to pull back. Third, we're more concentrated at the top of the S&P 500 than we've ever been in history. The Magnificent Seven have a massive hold on the market. And if you're newer to investing, the Magnificent Seven stocks are Apple, Amazon, Microsoft, Google, Meta, Tesla, and Nvidia. And when those 7 stocks move, the whole market can move with them. Fourth, chips is a worldwide industry. Taiwan tensions, supply chain issues, transportation bottlenecks, even export restrictions can play very big roles when it comes to tech. And when these pressures add on things, they can really hit the chips industry first. And that's what we've seen recently with other export and other tariff talks that we've been seeing happen. And finally, we are about to enter a very major election year. And those elections can help play a very big role when it comes to market swings. A single win here or there can sometimes swing the market by a couple of points just because of what the expectations and restrictions that could bring. The market hates uncertainty. And when you add in all of these risks, it's what leads to profit taking and for people to start selling. So no, this is not a guaranteed buying opportunity, and anybody who tells you otherwise is trying to sell you something. But here's the good news. There is a strategic approach you can take when it comes to dealing with markets like this. It allows you to stay patient, make sure you're making really good logical decisions, and make it so you don't get as burned along the way. And that's exactly what I'm going to talk about next. So let's talk about what actually matters, and that's how you should respond to this pullback. And now this is the area where most investors make mistakes, and it's very easy for you to get burned. So first, and this advice is the easiest one to give and the hardest one to actually do, and that's don't panic. And when I mean don't panic, I mean don't panic sell, as well as don't panic buy. Sometimes when pullbacks happen, we see a really big market recovery, and the same emotion comes up as to when things are falling, and you feel like, oh man, I don't want to miss out on this, and you decide to buy. The moment you buy, all of a sudden the market direction turns, and you get burned for it. So it's really important that you have a plan to your buying decisions and that you approach it very logically so you don't allow emotions to take over. Second, stop trying to find the bottom of the market. No one times the market perfectly every single time. not the banks, not hedge funds, and definitely not me or you. And the good news is you don't have to be perfect. You just have to be close enough. And there's a proven method that allows you to be close enough most of the time. And this is called dollar cost averaging. And the way it works is really simple. All you do is buy consistently, rather if the market has gone up or if the market has gone down. Maybe this means finding a stock and only investing 25% of the money you have right now and buying it. The rest, you set up a schedule where every Tuesday or every other week or every month, whatever schedule makes sense for you, you put a little bit more in, and it allows you to buy both those times that the stock's been up and maybe sometimes when the stock has been down. Fourth, focus more on the stock's underlying business than their short-term stock price results. Just because a stock is going down does not mean it's a bad price. We want to make sure that we're staying up to speed with any news that has happened with the company, the latest earnings, and if all of that is really opposite of what you're seeing happening with the stock, it could present itself as an opportunity. So don't get caught up too much in sentiment and really stick to really what we know about the company and what the news is telling us from their latest earnings. Fifth is where you start separating companies that are the must-haves from the nice-to-haves. And earnings usually show these companies really quickly. When it comes to AI, we really want those companies that are the picks and shovels, the ones building the infrastructure of AI. These are the companies that if they pull back are some of the best opportunities because they are critical to technology moving forward. Where some of the other software companies, a new competitor can enter the space and make it so that their stock can go down from that and they have to consistently keep up. So again, you want to focus companies that are the part of the picks and shovels. And finally, make sure to keep extra cash on hand just in case the market pulls back further. The worst case scenario is if you're fully invested, you have no cash on hand, and the only way to generate cash is by selling something. We want to stay away from this situation, so it's important to keep a little bit of extra cash readily available. Now, with all of that in mind, let me take you through what I am personally doing with my own portfolio, the strategy and the steps that I am taking to take advantage of the continued slide within tech. First, I am not selling. Great companies don't turn into bad companies just because the stock goes down. With all the really strong earnings that we've had, specifically within AI tech, I feel really good about my portfolio, and my goal is just to take advantage of this opportunity. Second, I am scaling in with my extra cash slowly. I have several stocks that I like with an AI infrastructure, and I'm looking for opportunities when they pull back. Right around 10% is where I feel very comfortable to do additional payments. Everything else, all of my portfolio has dollar cost averaging weekly or monthly buys that automatically go out. This allows me to buy every single week when the tech stocks pull back and not even have to think about it. Third, I'm mainly focusing on must-have tech. I'm talking about the infrastructure of AI. I don't like getting caught up in all of the names that you see pop in the news every other week. I like the companies that are really driving and behind the structure of everything. Three of my favorites are Nvidia, AMD, and Broadcom. And every single time that those things pull back, they're gigantic opportunities because they have had nothing but stellar earnings between those three stocks. Fourth, regardless of how many continued pullbacks we continue to see, I always make sure to have a little bit of cash left still in my reserves. I don't want to be there if there's another very big pullback without having more money to put into the market. So it doesn't matter how much further the market will go down. I will never put all of my cash in because I always want to have a little bit available just in case I'm wrong. And I've been wrong before. And finally, I am sticking to earnings and really important news updates that are tied to those businesses making financial decisions. I really try my best to avoid clickbaity, emotional, media pushed headlines that are out there because they really are preying on your sentiment and they start really toying with your ability to make logical decisions. The media gets more clicks with negative sentiment. So all these authors and writers out there just drool at the opportunity for the market to pull back and for them to write the juiciest headline for you to click and make you as scared as possible. This is why logic will always win, and avoid these clickbaity things and stick to the fundamentals we've talked about in this video. So that's exactly what I'm doing during this pullback. I'm trying to stay logical and calm, focusing on those big names, scaling into them slowly, but not going too crazy to the point where I use up all of my cash reserves. I'm not trying to be a hero. I'm not trying to catch the bottom. All I'm trying to do is stick to a plan and a strategy that I've used for every single pullback that we've had for the last decade since I've been investing. And that's exactly what I want for you as well. So now it's your turn. What is your strategy that you're trying to put into play for this pullback? I would love to hear more about it, so please throw in the comments below and I'll be sure to read and check it out. Maybe you didn't have a strategy and you learned something today. Well, please give this video a like, subscribe to my channel, and make sure you don't miss the next video. Thanks for watching. We'll see you next time.